Please stay tuned after the conclusion of the podcast for additional important information. Hey everybody, welcome to another episode of Accrued Interest, PIMCO's podcast dedicating to serving financial advisors and the wealth community. As always, my name is Greg Hall. I'm your host for the program. And today I'm really excited to be joined in our Newport Beach studio by Andrew Balls. Andrew is our CIO for Global Fixed Income. And the stars have aligned. We find ourselves both in the same place in Newport Beach. I'm usually in New York. He's usually in London, but here we are together today. Andrew, thank you for taking the time to join us.
Great. Good to be here. I actually thought you were going to be in New York. So it's a nice surprise that we're both here together.
It's a little bonus. We can be like that much more natural and we don't have to do this over Zoom. I have wanted to have you on the podcast for some time, and there may be two reasons for that. One is we don't get to spend a lot of time together. You're over in London managing our investment operation over there. My job has become, quite domestic. My travels take me to St. Louis and Paducah, Kentucky, and but not so much over to London any longer. So we overlap at our investment forums, and every once in a while get to share a few words. But we don't often get a chance to have in-depth conversations. So this is a treat for me. And then secondly, and maybe more important to those listening is, we as a firm, really since the rate reset in 22, 23, have been talking about U.S. investors needing to look a little bit more globally to find investment ideas. And this whole idea that we're in an environment that is characterized by a little bit less global synchronization, and so opportunities emerging in different geographies that create the opportunity for diversification and excess return. And so we've had Dan Ivison on the pod to talk about it. We've had Mark Seidner on the pod to talk about it. We've had a bunch of Americans talking about opportunities outside the U.S., and now we get to consult a local expert, a true expert. So thanks for coming to do that with us.
Okay, well, great. I think Dan and Mark are true experts as well. So
yeah. Well, that's I'm going to pay for that
but
one later.
I've got the London location. That's
you've got the accent at the very least, and I think if nothing else, then that'll give you 20 or 30% additional credibility. Why don't you've had a really interesting road to being here at PIMCO, and I think the advisors listening would actually get a kick out of hearing how you came to be in your seat.
So I joined 20 years ago here in Newport Beach, and then I was here for a few years, and I moved to London after the Lehman crisis. And before I joined PIMCO, I was at the Financial Times. So I was a columnist, and then I was an economics writer for the FT. So I was covering the Federal Reserve in Washington, D.C. So I was there for the last period with Alan Greenspan and the Bernanke transition. And I covered global economics for the FT, and I got to know people at PIMCO well, and I joined here as a global strategist. So I did that with our global desk here, and then I started managing global portfolios. And then a few years later, I became head of our European team. And then when we had our transition in 2014, since then I've been the CIO for global fixed income, and a big part of my job is managing global bond funds, and in the US, international bond funds. And I work very closely with the team here in Newport Beach. I'm here quite a lot. And then, of course, I work with the team in Europe, in Asia. I work closely with Pramal and the emerging markets team as well.
Yeah, Pramal he's a recurring guest on the podcast. He and Mark are on each quarter talking about their PIMCO Perspectives piece, and they were actually our last couple of guests. It's not that common to see folks move from a journalistic role into managing money. What do you think it was about your experience, or was there a piece that you wrote that got the attention of the folks here, or a line of inquiry?
I knew the people. This seems like a long time ago now, but when I joined the firm, we had one or two people who looked at policy. And so Rich Clarida and I joined together to be looking at policy for PIMCO. And it seems funny now because you had 2008 and government intervention across all of the markets. And now it feels like everybody looks at policy all the time. But back then they wanted to strengthen the effort on policy. So I got to know the firm well. And, I thought it might be a hard transition. And the first day I came in, I was presenting at the investment committee on what the Fed was going to do. And it was not, half of the job is very similar to what I used to do. The other half is very different. But you're spending time thinking about macro markets, central banks. That's all quite similar. And then the other part of the job, managing money, the mechanics of markets, is something that you learn on the job.
Yeah. Yeah. Well, let's talk about the mechanics of markets, and let's talk about managing money right now. Amongst your many responsibilities here at PIMCO, you author our, or at least many of our investment forum pieces, and listeners to the pod will recognize these as the things we publish 4 times a year after we have a large internal gathering. 3 times a year, we write what is called our cyclical forum outlook, which focuses on a 6-month time frame or thereabouts. And then once a year, we do a secular forum where we try to attack the biggest themes in markets, things that we think will influence markets over 5 years and beyond. And Andrew co-authored the most recent piece, Rupture and Resilience, and amongst the theses laid out in that piece was a prediction that with a new Fed, with global desynchronization, we may encounter a bit more volatility than we've been used to in global markets, and that prediction seems to be coming true, at least over the short term here. Andrew, do you want to maybe just level set us on how you're thinking about the investment environment today, and particularly with a non-U.S. angle, though please talk about the U.S. from your perspective as well.
Sure. So we think we're going to have these repeated periods of volatility. So we had interesting markets here in the US last week, but we've had this across different countries. We've had this in the UK, in Japan. We've had this in Germany over the last year and a half. I mean, I think part of this is, starting conditions, high levels of debt. You can have periods of volatility. It may be that the markets are focusing on fiscal. It may be markets are focusing on the central bank, which seemed to be more of the story here in the US last week. And so I think, us as active managers, we need to be ready for this. And, there's always good opportunities. We like volatility. We like occasions when you may see markets move a little bit away from the fundamentals. And, that gives us an opportunity to take the other side or to go along with it, depending on how we see the opportunity. And then the secular outlook, Rupture and Resilience, I think part of this is, if you look back, so I was talking about when I started at the firm, a reasonable model for kind of policy analysis is assume that governments do the right thing. It may take a little bit of time to get there, but
once they've exhausted all the other options,
exactly.
Yeah.
And then on the central banking side, assuming that you get to the right place, there may be a bit of a lag. You may have institutional or bureaucratic reasons, but anticipate that path and then position for it. So the kind of the key organizing thing on the policy side would be the economics, drives the politics. And as we say in our outlook, I think that's turned it on its head in the US quite prominently, but across the world, the politics is driving the economics. And you see that in terms of the US, and you see this in terms of the President Trump's administration. But then you see this in other countries. If you look at globally at kind of government interventions, industrial policy, kind of favoring domestic firms in procurement, all these kinds of things on the fiscal side as well. And at PIMCO, we have a tradition of investing around public policy, investing around government reaction functions. So I think this is a good environment for us as active managers. And then we're going to have lots of global opportunities because these shocks, these challenges will have different impacts on different countries.
I'd love to, if I can interrupt, I want to talk about that a little bit. I think I underestimate sometimes the amount of attention that U.S. financial advisors pay to overseas developments. When I go do meetings throughout the country, I'm often pleasantly surprised by the degree of familiarity with what's going on in Japan, what's going on in the UK. But for those who maybe are using this episode as a little bit of a catch up, I think it'd be really interesting to talk about the political developments in Japan that have caused a reshaping of the yield curve over there. Obviously, you in the UK have just lived through a political transition. So maybe we can kind of go into and you can maybe illustrate what you mean by politics driving economics.
So Japan is interesting. So there's a prime minister who is quite radical in terms of her agenda, kind of a return to the Abenomics period. Again, the politics very much driving the economics. They want to use fiscal policy to support growth and to put pressure on the BOJ to keep interest rates low. And then this has run into, again, another oil price shock that we are living through. And there's pressure here in terms of the system. And we've seen yen intervention. We saw it last week. We saw it earlier in the year.
And that's the BOJ buying?
That is the Ministry of Finance intervention. And what we have there is the combination of fairly loose monetary policy, given the level of real yield, say, and the fiscal expansion is currency unfriendly, and the yen is at weak levels. And we saw intervention last week to try and strengthen the yen. Now, this is a complicated situation because you might think if you want a stronger currency, then the central bank may just want to raise short-term interest rates more. And the BOJ, of course, left rates on hold last week. So you have this inconsistency in terms of the system. And these are the kind of policy interventions that don't really work. If you have you come in and you buy the yen, you can flush out shorts. You can have a short-term impact, but it doesn't tend to have a lasting impact. And we saw intervention earlier in the year. Now, a really interesting part of this on this occasion is the US did some intervention as well. So they bought the Japanese yen late on Friday, and then they sold the euro, which is interesting because you might think they would sell the dollar, but I guess they didn't want to send too much of a signal there. And
is that political in the US, do you think, as well?
I think it's I think it was a pretty confusing thing to do. Probably blunts a little bit the impact of coordinated intervention. But I guess the signal is that the yen should be stronger, but not necessarily against the US dollar. But I do think it kind of blunts the impact of coordinated intervention. But why might the Treasury be interested in this joint intervention, the US Treasury? And I think it just speaks to this point you made about global factors impacting US markets. The Japan curve has steepened a lot. The 30-year JGB has sold off significantly over the last year. The curve is very steep, steepest among the G10. And I think there is a perception that this has an impact on yields at the long end of the US curve. Maybe markets extrapolate the fact that Japanese investors, big holders of overseas assets, might reduce their holdings of overseas assets.
Right, they can bring money home. And have some of the same return rates that they do overseas.
So I think part of the angle for the US Treasury is probably the belief, the feeling that the steepening of the curve in Japan has put pressure on long end rates in the US. And so you can do some currency interventions to strengthen the currency. So Japan, the long end of the curve, it looks relatively attractive. There's enough risk premium there. And you might combine that with being underweight in the 2-year part of the curve or the 10-year part of the curve, anticipating over time that short rates should be higher. And this would lead to flattening of the curve, some outperformance of the long end part of the curve. The UK, we have had a change in terms of the Prime Minister. This is interesting from a bond market point of view. We'll have a budget in October, and there'll be a lot of focus on the fiscal plans of the government. They have a set of rules. They've said that they will stick with the same rules as the previous chancellor of the previous finance minister, previous prime minister, but this adds some uncertainty in terms of the markets.
And so the new prime minister, Andy Burnham, he leans a bit to the left, yes?
He is a social democrat. He is pretty centrist. From a market's point of view, we will need to think about fiscal policy the gilt market is sensitive to fiscal policy. The signals have all been, pretty good actually. But in terms of the risk premium, there is, some potential for the markets to build more risk premium in the long end of the curve, like I just talked about in Japan. So what we will tend to do in our portfolios there is to be positioned at the front end of the curve, the 2-year, the 5-year part of the curve. And, this relates to global repricing since March. There's a lot of risk premium in the front end of the curve across markets, given the oil price shock that we've had this year. The UK would be one of the, I think, most attractive front-end positions to have. So I think it's a good opportunity for us. But for now, steer away from the longer end of the curve. And if we price in more risk premium over time, maybe a good opportunity later. But I think it's important, we talked about the global environment, the secular environment. It's a good environment for active managers. Choose the parts of the curve where you want to be exposed. In the UK, probably the 2-year, not the 30-year. In Japan, the 30-year, not the 2-year.
I noticed that as you were speaking.
And across the different markets, look to position for the most attractive opportunity. We don't need to just have exposure across the whole of the curve.
Sort of isolate where you want to express your duration, both geographically and chronologically, or in terms of tenor. Yeah,
in terms of the curve.
Yeah. And it seemed to me, I guess, the way you set up the conversation was interesting. We're starting from a position where there's a lot of debt in the world, and it feels, it's probably not the right term for it, but tight. The markets won't really allow a lot of fiscal wiggle room or monetary policy wiggle room. They tend to react, or at least we've seen them react meaningfully and quickly over the last 6-8 months, almost maybe in disbelief of fiscal discipline or fading the ability of governments to tone that down.
Yeah, no, I think that's right. And I think when you look at over 3 to 5 years, you have not a lot of fiscal space across the G10 countries. In the event of a shock, a downward shift in terms of the economy, it's probably going to be monetary policy that needs to do more of the work, not fiscal. Now, the initial conditions in terms of the level of market interest rates provide that room. We're well away from that period of zero interest rates, zero bound, we're negative interest rates in some countries. We're out of the period of, for the most part, quantitative easing, yield curve control. So in the event of a shock, it would be monetary policy that does the heavy lifting. So we earn the yield that we earn on the funds. Again, 5 to 7% type yields looks very attractive just in terms of the expected return. But in the event of a shock, in the event of a recession or an equity market correction, the potential for capital gains, given the scope for central banks to cut rates. And then in steady state, I think that we've seen this in a number of markets. We saw a 30 basis point move one day in Germany last year. We saw a 30 basis point move in the long end of the UK one day last year. We should just anticipate these periods of volatility, dislocation. We can protect portfolios against that in terms of where we choose to position on the yield curve. And then we can look to benefit from this when you see good opportunities, because you will have periods where market pricing moves away from the fundamentals. And so I think Japan would be a case. You do have excess risk premium in the long end of the curve. So being overweight the long end versus the 10-year or the 2-year, say, should be a good trade over the next couple of years.
What about the rest of Europe outside the UK?
So Europe, so again, one of the themes we have is less synchronized global cycles. The ECB has hiked interest rates this year. The US has been on hold. The UK has been on hold. Pretty good chance, very good chance actually, that we'll get another rate hike in September. In the initial phases, Europe, single mandate central bank, not a dual mandate like the Federal Reserve. The impact of energy prices for energy importing countries is particularly important. And so we started off with this shock with Europe, the UK, the initial drivers. But then, this is a global energy price shock. You want to look at the impact across all countries. The US somewhat more protected by the fact it's energy sufficient. But, Asia, most of the countries in Asia are going to be energy importers, not just Europe. The market initially priced this very much as a kind of a European shock, maybe looking back to 2022, when the energy price movements were Russia, Ukraine related, Russian gas related. So one thing we did in global portfolios was to look to add some European duration, some UK duration when it sold off. And the other side of the relative value was to sell duration in Asia. So Singapore was a good opportunity. And then over time, the market repriced yields higher globally. So the March shock more driven by Europe, and then this broadening subsequently, including the US, although a happier tale in the US with AI and optimism around the AI capex cycle as a driver, whereas in the rest of the world, more the oil beta as a driver.
I wanted to ask you, wow, there's so many interesting topics. I wanted to ask you about the AI cycle in Europe versus the US primarily. How do perceptions of that differ as a global spending and growth phenomenon? And then obviously the way it lands in terms of the local fundamentals is very different in the UK and Europe than in the US. So do you are you underwriting investments with sort of a thought that there's no benefit from the AI spending cycle in those parts of the world, or is it more nuanced than that?
So I'd say the AI cycle is something that has clearly been dominated by the US and China, and then there's other countries in Asia, Korea, Taiwan, benefiting as well in terms of the supply of chips, etc. I think it is something which over time will be a positive in other countries. You'll have this AI capex cycle globally. I don't think it will be to the same degree as we have here in the US. The benefits in terms of the use of the technology, again, should be felt globally. I mean, the big thing which has been happening this year and last year has been the boost to US growth, and that's been very important. It's been a real stabilizer for the US outperformance versus the rest of the world. And then the other thing has been issuance. So issuance, the growth of issuance in the technology sector has been, really large, driven by the US, but that will reprice global markets. And so there's only so much global appetite for credit, and when the U.S. companies have a lot of issuance, it will suck demand, or it will widen spreads. All things being equal, Yeah, so credit is a very global market. So the increased issuance in the US, sucking in the capital, as you said,
maybe
have
not
an impact.
as elegantly as I might have,
but it will have an impact on the global sector. Markets price credit in terms of the global sectors. You'll have issuance by US companies in other jurisdictions. And it's really interesting because if you look back over the past, so you had the widening of spreads. This is very interesting, 50 to 100 basis points of widening in terms of US tech sector. The growth of issuance is enormous. We at PIMCO will be careful in terms of the generic exposure because there is a lot of issuance, but we'll look to do good deals where we can get the economics that we want, where we can design the terms of the security to suit our needs. So, be careful on the generic stuff and look for the good bespoke opportunities. And we started earlier talking about rupture and resilience. I mean, you've had a lot of policy uncertainty coming from the US. You had Liberation Day a year ago. You've had, a lot of discussion on international investors, their exposure to the US, very, overweight exposures to the US. But you've seen real stability in terms of these exposures, not very much in terms of shifts in asset allocation, certainly really not that much in terms of hedging behavior either.
Meaning non-US investors in US treasuries.
Treasuries, but also the whole equities and the US Inc. And part of the reason why, you had a lot of noise around Liberation Day, but not a lot of changes in behavior, is from the international investor point of view, if you want to have exposure to AI, then you need to have exposure to the US equity market. So I think that's been another interesting phenomenon over the past year. You've had the policy uncertainty, the rupture, the resilience, but then you've had this big stabilizing factor in terms of the performance of the US economy, the leadership in terms of AI.
One of the themes that's more European specific that folks have discussed as maybe its own, maybe not to the same extent as AI, but still an important growth driver would be European rearmament, the need for Europe to spend more on defense, not just given geopolitical threats, but obviously the U.S. taking a more reticent position in terms of extending its own shield over Western partners. How do you evaluate that amongst the both macroeconomically as well as from a tactical perspective?
So I think it's real. I think that you will see growth in defense spending in Europe over the next 5-10 years. I think you need to be careful not to overdo it, because I think that countries will drag their feet. There'll be long-term goals in terms of 3.5% defense spending, but not getting there super quickly in a number of cases. But I do think it's real. I do think it's something which is important. And the key thing has been Germany, where you have had more of a shift in terms of Germany, and it's a combination of defense spending, but also infrastructure spending in Germany. The German economy had been in recession for a couple of years. The government had very restrictive fiscal framework, and they loosened that. And so the main shift you're going to see in Europe, I think, is Germany. This is interesting in a number of ways. It's interesting in terms of the relative value in terms of German bonds versus other European sovereign markets. It should be interesting over time in terms of the yield curve in Europe. You've actually got quite a flat yield curve, 10s to 30s, particularly in swaps. When you look at the interest rate swaps, when you look at the European market. So I think positioning for longer term curve steepening in Europe makes sense, and probably somewhat reduced premium for German bonds versus other markets. So one thing that we have in our portfolios, particularly the European and global portfolios, is we're overweight Italy. You can pick up some extra income. Italy is a country where the fiscal framework, the debt levels are high, but the deficit is under control. And so over the coming years, you should see a rise in German debt levels versus Italy, say. And you may well see some reduction in the premium that we've paid historically for German bonds over something like Italy or Spain. So that's a good opportunity there. France is going somewhat in the other direction. Again, politics driving markets, politics driving economics. The French have high levels of deficits, elections coming up next year, which will lead to market uncertainty. And if we get a lot more noise later this year and into next year around the French elections, that's a good option value. In the baseline, I'm not sure we'll see a huge move in terms of the spread, but there's definitely the potential for the markets to price in more fiscal or more political risk premium in France. And so I think that's a good position to have.
Yeah, it's interesting, the variety of positioning you can create, in ostensibly connected but quite different economies. I wonder, on the security theme, one of the things I'd wanted to ask you is about perceptions of the Iran conflict, and not necessarily moral or political perceptions of it necessarily, but more, are there viewpoints amongst the folks you speak to in Europe about that conflict, its potential for resolution, its long-term impact on the energy ecosystem globally? Are there European viewpoints on that by virtue of maybe having Russia as a difficult energy partner over many decades, that you think U.S. investors ought to hear more of about how things might end up?
I think the way I would think about that more is probably, and we say this actually in terms of our secular outlook, energy could well remain an important driver in markets over the next 3 to 5 years. thinking about winners and losers is important. And that may be the national level, countries where they are relying on energy imports. You can see different outcomes, different risk profile compared with those which are more energy efficient. And I think that you can do that across G10. And you can certainly look across emerging markets and winners and losers in an environment of more pressure from commodity markets. Just as, there's other factors. We talked about AI. You're going to want to look at winners and losers across countries, but very much across sectors, across companies there. So I think that would be the main thing, that there'll be different political views in terms of the current situation. But from a market point of view, I think pricing the energy impacts across countries, across sectors, and just being aware that this could well be a recurring theme over the next several years.
What if you put yourself in the shoes of a U.S. financial advisor? And it's sort of an unfair question to hey, Andrew, just justify what you do for a living. But from the point of view of a financial advisor in the U.S., how would you make the case for greater involvement in international markets? What do you think it can add to a more domestically focused portfolio?
So I think in a fixed income environment, fixed income portfolio, so the first thing is the yields are attractive. So if you look at international bonds versus the US, as a hedged investor, you're getting very similar yields, slightly higher yields on the international side. So that's important. So there's not to give up in terms of the yield that you earn when you hedge the currency risk. If you have unhedged currency exposure, it looks a little bit different. I think for the most part with financial advisors, I think there's going to be a clear focus for the
dollar preference, yeah,
because there's no particular reason to have the unhedged exposure. If you may have some asset allocation reason, but so the hedged yields are very attractive, and I think the main thing to understand is the attractiveness of the hedged yields. The second thing to understand is we think there's real benefits of diversification over time. Your return per unit of volatility or return per unit of risk looks attractive when you have global exposure, because in any one year, you will have different performance across different bond markets. And when you look over time, you may just get superior return, risk-adjusted return. I say that's more compelling when you are comparing global or international with some of the smaller markets. The US is a very large, diversified market itself. So I think this is not as compelling in the US case, but still the numbers speak for themselves. And then the third thing, I think, and particularly in this environment, there's a good global alpha opportunity set. And you can do this by having exposure to international or global bond funds. But you can do this, PIMCO, of course, when we have good ideas, we'll do this across the complex. So in our strategies, making good use of the international opportunity set on the G10 side, on the EM side, again, to have the benefits of diversification and then the benefits in terms of the alpha opportunities. So a good environment for active managers. I always think, there was this kind of dull period when we in the 2010s when yields were lower, volatility was suppressed. You had central banks suppressing volatility, high correlation across markets. There wasn't the same opportunity set. I think today and going forward, benefit from the global opportunities, benefit from the volatility. Look to have portfolios which protect you against the downside risk, but look to exploit the opportunities. And if we have less synchronized cycles, if we have greater differentiation across markets, then that should be good in terms of active management.
Yeah, and that's right. And I think well, you've helped us do, I think, a couple of things today. One is explain, how diversification within the fixed income portfolio can enhance it, maybe decrease risk, maybe enhance return. But also you've laid out a pretty strong case for just fixed income generally. I would say by far the most prevalent theme amongst fixed income investing in U.S. financial advisors has just been the really unprecedented success of their equity portfolios over the last 10 or 15 years and the degree to which that has squeezed asset allocation. So 60-40 is so far in the rearview mirror. We're at 90-10, maybe 85-15 if somebody's very conservative. And so articulating, I think, the case for taking advantage of some of these higher yields and knowing that spans markets. It's not just limited to the U.S. It's important.
And I think Mark Sinder would have said this when he was on the podcast, I bet, because he said it on other occasions and Pramal and others. But I think to make a positive case for fixed income, I don't need to make a negative case on equities.
Yes.
But if I'm earning 6-7% yield on the portfolio, depending on what your assumptions are for your equity part of the portfolio, the 6 to 7% yield for fixed income looks pretty good. I mean, it looks like equity-like returns. Again, I'm not moaning about higher levels of government debt. They're part of the reason why we get these yield levels today. So, we should benefit from that. And then in an environment where you do have a bump in the road in terms of the economy or equity markets, you've got the potential for outperformance, double-digit returns. But just looking at the yields of the funds, if you get 6-7% type yield, that's a good guide to your expected return. And you don't need the central bank to cut rates. You don't need a recession. Right, but
Andrew,
in the event
you're familiar with the TikTok phenomenon of 6-7, right?
6-7. Okay, I do know what that is actually.
Yeah. I just thought you might be baiting me a little bit with the
reason the previous UK Prime Minister did this in a school visit and got told off by the teacher saying we don't do that in class.
Is that why he's the previous Prime Minister?
No, but I thought it was a nice moment actually. 6-7, 5-6-7.
I think this is a good point, maybe to end the discussion, on a fun note. But it's been such a pleasure to have you with us. Thank you so much for everything you do on behalf of PIMCO and its clients. Thanks for taking some time today to help us, bring some context and color to what you do globally for investors here in the U.S. For those of you listening, if anything today captured your fascination, your imagination, your interest, please visit us at PIMCO.com in the U.S., or if you're listening in another country, you can visit our local website there. If you identify yourself as a financial advisor, you'll be taken to Advisor Forum. That is our one-stop destination for you to find what you need quickly and efficiently from PIMCO so that you can digest the information, think about it, and then go on to having meaningful conversations with your clients. Andrew, it's been a pleasure having you, and we'll look to do this again hopefully next year and make you a recurring guest. But with that, we'll see you all next time. And don't forget to like and subscribe to the podcast. If you let us know you're out there, it'll help us bring you more and better content like hopefully we have today.
Thank you for having me. Great to join.
All right.
The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal pages/podcast disclosures